Okay, let me start that again, and I'm going to stand away from the lectern. So this, as I said, this paper sits on the shoulders of work that Emmanuel did with co-authors in this room on safe assets as well as on the international monetary system. One of the things that weighed on me the last couple of years was that I never got to present the paper to him. But on his last visit to Chicago in 2019, we had a nice walk around campus, and I presented to him some tentative ideas on this vector. And as one of his students, I think, mentioned yesterday, whenever you could get Emmanuel excited about something, you knew that it was a project worth pursuing. So he was very encouraging, and so it's an honor to be here presenting this at the conference. Okay, let's see. Okay, so this paper concerns the international monetary system. If you're wondering what that is, Geeta will explain it in a couple hours. In particular, it's concerned with cyclical properties of the international monetary system, and I would characterize in particular two dimensions of cyclicality which are particularly important. One concerns the US currency in the global financial system, the dollar, and the other concerns the US balance sheet. In particular, with respect to the dollar bonds pay relatively well when equities pay poorly, and dollar bonds also offer low expected returns in recessions when output has been declining, both of which together imply that dollar bonds are a hedge whose value rises in bad times. In terms of the balance sheet, it's well known that the US acts as an insurance provider to the rest of the world, and it loses wealth in bad times. Now, there's been a growing literature that Emmanuel and others have contributed to over the last 10 or 15 years trying to make sense of these patterns. And while we made substantial advances, I think it's still fair to say that we lack a business cycle model that can jointly capture these features and study their implications. In particular, there have been two classes of papers that have tried to wrestle with these three features of international financial markets. The first has emphasized something special about US Treasuries, as often summarized by a convenience yield on these safe assets. And you saw a couple of papers today make reference to that. While this class of models is quite successful in rationalizing patterns in currency markets vis-a-vis the dollar, it remains unclear what effects these time-varying convenience yield on dollar assets has for global output, for patterns of risk sharing, or for risk premia in financial markets. There's been another class of papers in this literature emphasizing that really what's different is actually the US has a greater capacity to bear risk than the rest of the world, maybe because of deeper financial markets in the US vis-a-vis elsewhere. And while that class of models can naturally match the cyclical positions of the US external balance sheet, it has a hard time matching the properties of the US dollar. In particular, a canonical result in this class of models is that if the US is providing insurance to the rest of the world, its consumption, as the relatively risk-tolerant investor, must fall in bad times, and in the presence of home bias and consumption, the dollar should then depreciate. The dollar will then be a risky asset as opposed to a hedge. So what we do in this paper is put on the table a business cycle model of the international monetary system which bridges these two views, the convenience yield view and the risk sharing view. We argue that the interaction can rationalize these patterns I talked about, and quantitatively this matters for macroeconomic fluctuations as well as stabilization policy. There's going to be three key features of this model. The first is a time-varying demand for safe dollar bonds. I'm going to think of treasuries as my working example. The second is differences in risk-bearing capacity across countries, namely that the US has a greater effective risk tolerance than the rest of the world. And the third is nominal rigidities. As I said, the aspiration of the paper is to embed these frictions, which in isolation have been studied in various contexts by various people, in a modern open economy New Keynesian model. The first key insight of the paper is that a flight to safe dollar bonds simultaneously generates an appreciation of the dollar in the foreign exchange market and a Keynesian global recession. Ex ante, that means then that dollar bonds are a hedge. They appreciate in bad times. That means that dollar bonds command a negative risk premium, as in you are willing to earn low expected returns relative to foreign assets to hold dollar bonds because they appreciate in bad states of the world. And as the relatively risk-tolerant investor, the theory makes predictions about how the US should be financing its positions. In particular, the US will hold a levered position in capital because it has a greater capacity to bear that risk, but it's importantly going to finance that with dollar bonds because that's another way in which it can insure the rest of the world by selling them liabilities that appreciate in bad times. We're going to quantitatively discipline this theory with evidence on financial market spreads and portfolios, and we'll validate it with co-movements between bond returns, equity returns, output, and net foreign assets, the stylized facts I started the paper with. And then we're going to trace out 5 key macro and policy implications. The first 3 concern fluctuations themselves. We'll first argue that absent the flight to safety, global output volatility would fall by 15%. In other words, these financial market shocks are an important contributor to macroeconomic fluctuations. Second, in terms of the external balance sheet, absent greater risk tolerance in the US than the rest of the world, valuation effects, which have been characterized in the work of Elaine and Pierre Levier, among others, would no longer stabilize the US external position. And so US net foreign asset volatility would effectively reflect US net export volatility. Third, we argue that both of these features were important in the Great Recession. And then turning to policy, we argue first that this framework provides a structural model accounting for the disproportionate effects of US monetary policy on global credit conditions and risk premia. This has been an empirical finding in the literature on the so-called global financial cycle that folks like Elaine and Shabnam and others have contributed to. In our model, because relatively risk-tolerant agents are going to endogenously borrow in dollars, a US monetary policy easing, which depreciates the dollar, revalues the balance sheets of relatively risk-tolerant investors. In our baseline model, it's the US itself. In natural generalizations with, let's say, banks and households, it's going to be banks that finance themselves in dollars. As relatively risk-tolerant agents get recapitalized, that lowers the global price of risk and that compresses risk premia in ways that would not be the case if it was a foreign monetary policy easing. And finally, this model opens the door for other types of macroeconomic policies, most notably what you might consider unconventional policies or macro-pru dollar swap lines as having non-neutral effects. In particular, in our model, dollar swap lines will be globally stimulative. Effectively, they counteract safety shocks, and they mitigate the global Keynesian recession. The paper sits in between literatures on convenience yields, international risk sharing that I mentioned, and a growing literature on what you might call asset demand shocks in macro finance and international. Let me emphasize the 2 papers on the bottom, which are the work of Emmanuel on safety traps and the global dimensions of safety traps. The essential economics in this paper is borrowed from those 2 papers. And I would say our contributions there, as I'll make clear, are to point out that their insights, which largely concern the zero lower bound period, about how the world can fall into safety traps at the ZLB, their results, we would argue, extend beyond such environments with the zero lower bound binding. More generally, they characterize any economy following conventional Taylor rules. The same economics will apply. And moreover, we try to embed these ideas in a modern quantitative model of the global economy, and we trace out their implications. And so I hope Emmanuel would have been proud. So what I want to do is walk you through the structure of the model. I'm then going to pare it down and communicate the essential economic insights. I'll then tell you a bit about how we parameterize the model. I'll show you some impulse responses, and then I'll walk through at a high level those implications to the extent I have time. So the basic structure of the model is a 2-country new Keynesian model with capital, home and foreign. I want to think about the US and maybe other G10 currency countries. For reasons I'm happy to talk about later, I think the model better speaks to kind of countries that are otherwise symmetric, and that's why I'm not going to naturally think about it as applying to emerging markets, although that would be a very interesting extension. To that workhorse model that we're all used to from international macro, we're going to add 2 essential ingredients: a notion of safe dollar bonds and heterogeneity and risk tolerance across countries. And then we're going to add a couple ingredients which are not essential to the main ideas, but are useful for quantification and to clarify mechanisms, namely Epstein's in preferences, which allow us to disentangle differences in risk aversion from the IES, and disaster risk, which helps us match moments regarding the equity premium globally. Let me first talk you through the problem facing a representative home household. There's going to be an analogous problem in foreign. That home household is going to have an Epstein-Zinn aggregator, overflow utility coming from consumption, some disutility of labor, phi of LT, and then some utility from holdings of safe dollar bonds. That's what this omega function is. These are the positions in safe dollar bonds and normalize it by the price level. We're going to be microfounding the convenience yield as bonds and utility, and I'll talk a bit about alternative microfoundations in a little bit. The consumption aggregator has a standard CES form with home bias. And so the resource constraint of the representative home agent is kind of classic open economy macro. On the left-hand side, that agent is choosing domestic consumption, foreign consumption. We're going to assume producer currency pricing. I'll talk a bit about implications, for instance, of dollar currency pricing and Geetha's work in a bit. But for now, producer currency pricing, this is the consumption decisions. These are the financial decisions. Positions in a safe dollar bond, call them treasuries. Another dollar bond, call them privately issued dollar assets. And then foreign denominated bonds. There's no difference between foreign safe and foreign other because foreign assets don't earn the liquidity premium. And then the representative household also chooses a position in capital. And that has some price QTK. On the right-hand side, the household earns labor income, pays some adjustment costs, nominal wages. This is the standard New Keynesian stuff. And then earns the payoff on its financial portfolio. What is that? The payoff on dollar bonds you came into the period with, the payoff on non-safe dollar bonds. And this difference between I and iota is the difference in rates of return between treasuries and other dollar assets. This is the rate of return on foreign bonds. This is the rate of return on capital. And these are some lump sum transfers. Home, the representative agent at home is going to have risk aversion of gamma, and the foreign agent is going to have risk aversion gamma star. They will not be the same thing in the quantitative model. That's going to generate some important predictions for risk sharing. So in equilibrium, on the margin, when you decide to hold dollar bonds, you're going to internalize that your payoff doesn't just reflect this, but also the fact that you like holding them. And the same thing is going to be true abroad. They like to hold treasuries. On the margin, it turns out in this environment, it's going to have to be the case since we both are at an interior position in our position in safe dollar bonds. The marginal non-pecuniary value at home and abroad is equated. And let me now comment a bit on what's going on here. This is a very reduced form way, albeit a common way, to capture the safety or liquidity value of certain financial assets. It follows in the tradition of Sadrowski or Krishnamurti visiting Jorgensen, thinking about liquidity benefits of certain interest-bearing assets as analogous to the liquidity benefits of money. And so in the same way we might put money in the utility function, here we're putting bonds in the utility function. There are alternative micro-foundations, like my co-author has in his job market paper, thinking about bonds being used as collateral. We conjecture you had very similar results. We're going to use a particularly easy functional form that's going to make our life easy for omega and omega star, because that functional form, which is in the paper, plus market clearing, is going to imply that the marginal non-pecuniary value of safe dollar bonds, of treasuries, is given by this expression. This is a latent variable, it's a shock, that tells you how much you like to hold these safe dollar bonds, omega TD. This is the supply of safe dollar bonds by the US government relative to aggregate world consumption. This parameter epsilon d has the interpretation of the demand elasticity in this omega function. The demand elasticity, how much more you would want to hold these safe dollar bonds when the yield goes up. And so what this basically says is that the equilibrium convenience yield, which we're going to denote omega t, reflects the latent demand for safety as well as the supply of these safe assets. The bigger is the latent demand for safety, the larger is the convenience yield. The greater is the supply of these safe assets, the smaller will be the equilibrium convenience yield. We're going to be talking about this as the key driving force in the model. It's called the safety shock. But towards the end of the paper, I'll think about how the government could respond to those safety shocks by adjusting the supply of safe dollar bonds via, for instance, dollar swap lines and the implications for the real economy. How does this equilibrium omega, which is an equilibrium object, how does it propagate in this model? Well, it's useful to look at the four first order conditions of the representative home household. First, the household has to be indifferent between holding safe treasuries and holding other privately issued dollar bonds. And what this says is the higher is omega, the higher must be the return on that that not safe privately issued stuff to make the indifference between holding that and holding treasuries. Okay? These three equations are the portfolio choice conditions equating my choice between safe dollar bonds in these two cases versus holding capital or holding the foreign bond. And so again, if this thing is higher because I really want to hold the safe asset, then the expected return to holding capital must go up, or the expected return to holding foreign bonds must go up. Finally, this is my intertemporal Euler equation. This says I have to be indifferent between consuming today or saving today. In the usual way, the higher this is, that may have effects on the SDF and on the consumption allocation. Okay, before I keep going and walk you through the main economics, let me just maybe fix ideas and show you a picture of what this equilibrium omega looks like in the data, what's at stake here. So one of the nice things these formulas make clear is that the cleanest way to identify omega is to look at the spread between safe treasuries and what you might call other dollar-denominated assets, which don't carry the same safety or liquidity properties. That way you ignore all this risk stuff down here, all this exchange rate stuff down here, you kind of focus over here. So what are some natural candidates for dollar-denominated assets which may not offer the same safety or liquidity properties? Well, there's been a large empirical literature the last few years exactly after this point. There are two natural measures one can use in this context. One is the difference between privately issued commercial paper and the treasury bill yield. Another is, let's look at foreign government bonds. Let's swap them into dollars in the forward markets and compare them to treasury. Okay? Importantly, I want to emphasize, this is a version of a CIP deviation, but it's not the version that you may have seen in most papers which emphasize financial frictions, breakdown in financial markets. This is what people would call the treasury basis. It's really reflecting the safety offered by the US government versus foreign governments. We're plotting both of these on the same axis, and we put a couple markers here for key global economic events. I want you to take away a couple things from this figure. The first is the striking co-movement between these two series. I should say in particular the G10 TIBO series is in particular from the work of Duhem and Schrager. The first thing you see is the striking co-movement. The second thing you see is that this convenience yield, the fact that you would be willing to hold treasuries at a lower yield versus these other assets, spikes in times of market turmoil that we would all read in the Financial Times or the Wall Street Journal. And the third is that these are not small numbers. We're talking here in terms of crisis of 100 or 200 basis points. And so the name of the game is to trace through what might be the macro consequences of this flight to safety. Finally, let me just note as a quantitative point that if AA commercial paper or swapped foreign government bonds also offer some safety or liquidity properties, then this may understate the true flight to safety in the economy in bad times. Okay, let me finally close the supply side of the model, and then as I promised, I'm going to go to an even simpler version of this, a special case, and walk you through some analytical insights. The supply side of this model is intentionally from a workhorse New Keynesian structure. There's going to be a differentiated labor, as I mentioned, quadratic wage adjustment costs. Production is going to occur with domestic labor, as well as capital rented on the international market. I should say that latter assumption might be a bit unusual. This model, it's going to be complicated to solve. We're going to solve it globally with some methods that we've developed in other papers. It's going to be helpful to limit the state space, and so we're going to solve it with one aggregate capital stock globally that's rented across borders. You could extend this to having two separate capital stocks. Capital is produced with an unbiased aggregator, and there's adjustment costs in the usual way, so Q is going to move around. Monetary policy is going to follow conventional Taylor rules with coefficients phi on domestic CPIs. And as I mentioned, I'm going to start the paper thinking about the fiscal authority as setting the supply of safe government bonds to a constant fraction of global output. That means that all the variation in omega in the model is coming from the demand for safety rather than the supply. And towards the end of the paper, I'll trace through the effects of changes in the supply side. So just to summarize, in a quantitative model, there's going to be a number of driving forces. Again, the goal is to have something that is close to the frontier of open economy models that we can see how important these shocks are. So we're going to have a unit root productivity process, including a rare disaster, a time varying probability, so the model has meaningful variation in risk premia, time variation at omega TD, the demand for safe dollar bonds, We also have relative productivity shocks, and we're going to have unexpected policy shocks at the end of the talk, as I mentioned. The model is going to be solved globally when we get to the quantification, but first I want to communicate the main ideas via perturbation. Andreas.
So is your safety shock the only demand shock here?
I think you could think of it until I get to monetary policy.
Is your estimation then going to load a lot of the demand shock stuff onto that safety shock?
I think it's an interesting question. The moments that we're going to use to discipline, the moments that we're really after are around co-movements between relative bond returns and equity returns, and moments like that. I don't think pure beta shocks, for instance, would deliver those co-movements. So I think it's fair that we're missing some demand shocks. One of the things I'm going to show you is like a decomposition of the sort of Gorinchan ray. You'll see that the model has a lot of movements in risk premia, not so many movements outside of risk premia. That's because I think we don't have some of the other pure macro shocks you typically have in these models, like beta shocks. I think in that dimension they would be helpful, but I think for the core co-movements we're after, they wouldn't really affect things. Okay, so here's the simple case of this model that we're going to then characterize analytically. First, I want to think about two cases, either flexible wages or wages set one period in advance. I want to think about a fixed global capital stock, so there's no important effects on investment, but we will have endogenous output through changes in consumption. I'm going to specialize to the case of a unitary IES, as well as full home bias and an infinite Frisch elasticity. This is just parametric conditions that make the closed forms simple. They're not essential. I'm going to focus on a case with no disaster shocks, no relative productivity. Just think about safety shocks and global productivity shocks. Two shocks to make the simple points I want. And finally, I want to think about a deterministic steady state with identical per capita wealth. I'm going to use hats to think about deviations from that deterministic steady state only for the next 3 slides. As I said, the model is solved globally. And I'm going to walk you through 4 propositions. What's the broad narrative? First, I want to assume identical portfolios, and I want to laser in on what are the global effects of a flight to safe dollar bonds. I then want to endogenize international portfolios and think about risk premia. And there's going to be an important interaction between the flight to safety and heterogeneity and risk tolerance. Let me start with the first proposition. Consider, in the case with symmetric portfolios, a positive flight to safe dollar bonds, a positive shock to omega. Well, if we had absent nominal rigidities, what would happen? We would have a decline in the real interest rate at home, we would have a deflation at home, and we would have no changes in other prices nor the real allocation. In other words, this shock is effectively neutral for macro. We don't really care about it. It's going to change real interest rates. It's not going to affect allocations otherwise. Why is that? You can get the intuition from these 2 key first order conditions. This is the indifference condition between consuming versus saving. This is the indifference condition between holding safe dollar bonds and holding foreign bonds. This is from the perspective of a home agent. You get the same analysis from the other perspective. What's happening is everybody wants to hold these safe dollar bonds, so this thing goes up. But in equilibrium, the real interest rate on those safe dollar bonds simply falls to accommodate that demand. So over here, nothing has to happen with the SDF, and over here, nothing has to happen with real exchange rates. You simply have this whole thing being unchanged because R responds to omega. Okay, so absent nominal rigidity, this is just accommodated by a change in interest rates. In particular, when the central bank follows a Taylor rule, even absent nominal rigidity, how is it that the real interest rates fall? Well, there's deflationary pressure at home. There's deflationary pressure in the US to which the Fed responds by cutting interest rates. The real interest rate falls, and that accommodates that safe asset demand. Now consider the same shock, but add nominal rigidity. So let's isolate the role of that friction in this environment. In the presence of nominal rigidity, let me first walk you through what happens, and then I'll explain the intuition. With nominal rigidity, there's a smaller decline in the real interest rate than would be the case absent nominal frictions. The dollar appreciates on impact, both in nominal and real terms, and there's a global decline in output, particularly so in the US. What's the intuition? Let's look at these 2 equations. If you take my word for it that the real interest rate doesn't fall by enough in the presence of nominal rigidities, then if this thing actually is going up, this thing has to fall. Okay? And so what's going to happen is there's going to be a Keynesian recession. People want to drive to the safe asset. That generates a global reduction in economic activity. Over here, if people want to hold a safe asset, what's going to happen in the foreign exchange market? Well, the dollar must appreciate today, so it can be expected to depreciate going forward, so that you can earn money investing in the foreign bond and convert it back to dollars. So you get a Keynesian recession on the output side, you get an appreciation of the dollar in the foreign exchange market. What links those two responses? There's a relatively larger recession in the US than abroad, which means that the relative supply of US goods falls, the US terms of trade appreciate, and that underlies the appreciation in the foreign exchange market. This basic economics echoes a central point in the work of Farhi and Farhi. They make these points in the context of, in particular, US monetary policy being at the zero lower bound. And they note that if there's a flight to safe assets in that environment, that's going to generate a global recession, that's going to generate some appreciation of the reserve currency issuer, and they phrase this as another form of a reserve currency, a paradox or a trap, that the reserve currency issuers bear the disproportionate cost of flight to safety episodes. And so the point that we're trying to make here is that while this is true in the zero lower bound environment, it is true more generically for any conventional Taylor rule. That on following any conventional Taylor rule, as long as you don't track the natural rate one for one, which the conventional Taylor rule of this form will not, you're going to get the same qualitative predictions. Now, turning from the macro effects to the implications for portfolios and risk premia, I want to think about ex ante, what are the implications for the beta of the dollar and for international risk sharing. In this environment, by construction, we have two shocks, global productivity and the flight to safety. And we have three assets, capital, dollar bonds, and foreign bonds. And so to use the language of Curta and Gurinshaw, markets are locally complete. And so we can use our nice Backus-Smith condition and kind of ask what portfolios would implement efficient risk sharing. And that's what we do. The next proposition points out that as home gets more risk tolerant than foreign in this world, you have two interesting things happen. The first is kind of straightforward. Home's portfolio share in capital is going to go up. Naturally, capital is subject to TFP shocks. It's risky. If home is more risk tolerant than foreign, it is better able to bear that risk. It's going to load on capital. Okay? It looks like the US having a long position in equities. The more novel part in our paper is that we also have a prediction on the liability side. That the other way that home can insure foreign is to sell dollar bonds, to finance itself in dollars, because the dollar in this model is endogenously a negative beta asset. It appreciates in bad times. And so you don't just provide insurance on the asset side of your balance sheet, you also provide insurance on the liability side. The final proposition asks ex ante, what are the implications for risk premia? The first point is, if we didn't have safety shocks, if home was more risk tolerant than foreign, then dollar bonds would actually have a positive beta. They would depreciate in bad times because home's relative wealth would fall in bad times because it's long capital. And that would cause a dollar depreciation. So ex ante, the expected exit returns on foreign bonds would be negative versus dollars. In other words, you have a positive risk premium on dollar bonds. This is the so-called reserve currency paradox of Gurinshaw-Ray-Govillot or Maggiore. In our model, the addition of safety shocks can reverse that. Because with those safety shocks, the dollar now appreciates in bad times. And so ex ante, you will have a positive risk premium on foreign bonds versus dollar bonds if those omega shocks are big enough. So those are the main ideas of the paper. And in my remaining few minutes, I want to talk you through the broad strategy of how we discipline the richer quantitative model. I'll show you the key co-movements, and I'll walk through a selected set of the implications for fluctuations and policy. A risk premium shock. So,
risk premium shock on the emerging markets, because that would be a safety shock on the
I think there's sort of two questions there. One is the application to emerging markets versus other G10 currency countries. The other one is, are there other ways to resolve the paradox? Let me decouple them. As I mentioned, I think this model I think is better suited to explain why the dollar has a safety properties vis-a-vis the euro or the British pound, because I agree with emerging markets when there's another broader set of shocks one could consider. There's a separate issue, which is just conceptually, even playing this game, are there other sets of shocks one could think about? Pierre-Levier and Elaine have explored the possibility of time-varying risk aversion in the rest of the world. Matteo, in his job market paper, suggests the possibility of time-varying trade costs. We contrast both with our mechanism in the appendix of our paper. Let me briefly just say, these are all complementary mechanisms. An important difference is that in the papers that I just mentioned, those are endowment economies. We point out once you embed them in a new Keynesian production context, both of those shocks, a forward risk aversion shock or a trade cost shock, actually generate an output boom in the US. It's observationally different from this. They also have different policy implications. So for instance, the implications for the role of dollar swap lines is a natural one in a model like this, less so in the others. But I think, in terms of the exchange rate effects, they go in similar directions. Yeah.
Can you track, Helen is here, but it's not just the risk aversion shock. So in part, it's not able to be risk aversion is a function of output, right, or expectation of future output. So how would you generate boom? Anyway, we can talk later.
Yeah, we can talk later. I mean, it's sort of like the way at Matteo's job market paper, trade costs are a function of the aggregate disaster state or the disaster probability. I think there may be ways to enrich where the time variation in trade costs or risk aversion comes from that might generate qualitatively similar co-movements. Again, I would say even setting that aside, I think the policy implications would also be different, though, in terms of things like dollar swap lines. You need a model of segmentation to generate some action there. Okay, so let me talk briefly. How do we calibrate this type of model? As I mentioned at the very beginning, we're going to discipline the stochastic properties of the safety shock with the G10 T-bill spread. So this is using the work of Duhem and Schrager. We're going to use things like the persistence and so on calibrated directly from the data, but we will calibrate the volatility of these safety shocks to match the conditional correlation of the global equity return and the excess foreign bond return. In other words, we're going to, leaning on the structure of the predictions of the model, calibrate the magnitude of these shocks to match the negative beta of the dollar in a conditional way. Disaster shocks the literature and the relative risk aversion across countries is going to be used to match the US net foreign asset exposure to excess equity returns. Okay, so the fact that the US has a levered balance sheet. How are we going to assess the model then ex post? We're going to look at things like the predictability of excess foreign bond returns. Does output predict that? The co-movement of excess foreign bond returns with equity returns, and the co-movement with excess foreign bond returns. So these are all untargeted, and these capture the cyclical properties of the dollar and the US external balance sheet that I started the paper with. Andreas, go ahead.
I'm wondering if you have the disasters in a global solution, you would get changes, like endogenous changes in the relative demand for safety, just if you're in a bad, uncertain state, right? Would you estimate the omega shock then?
So there's two things there. One is absolutely, intentionally the way we set up this model was in the tradition of modern DSG models. We're going to feed this in as a driving force. And our view was you can parameterize the omega as having some correlation to global disasters. So this is not like coming from nowhere. And I should have said this up front. There's exciting work, I think, in this space trying to endogenize where these convenience yields come from. That's not what this paper is. This is about thinking about their propagation in a conventional macro model. But you could have omega being correlated with other shocks like disaster risk. And indeed, that's what we do in our calibration based on the correlation between these financial market spreads and these measures of disaster probability. There's a conceptual point, I think, behind your question, which I want to clarify. An increase in the global disaster probability itself is not going to generate the co-movements you need. In fact, give me 2 slides and I'll show you that. Okay. This is a bunch of externally set parameters. Let me just say largely standard, nothing really crazy going on here. Here are the key calibration targets. The broad message is we're calibrating conventional macro moments like consumption and output volatility, as well as financial moments like level of interest rates, risk premia. Before I show you the key untargeted moments, let me show you 2 key impulse responses. This is just going to try to drive home the key message from the analytical results. To Andreas's point, let's first look at the effect of an increase in global disaster risk. and let's clarify why this cannot match the co-movements that we were after at the beginning of this paper. There's 6 panels here. An increase in disaster probability, that's the shock. This is excess returns on global equities. This is excess returns on foreign bonds versus dollar bonds. This is the real exchange rate. Up means the dollar appreciates. This is the relative wealth of the US. This is a key state variable in the model, given that the model has heterogeneity. And this is output in the US. The picture for foreign is going to look qualitatively similar. What's the key message? An increase in global disaster risk in this model generates a collapse in global equity markets and then high excess returns because risk premium are high. That's standard. It generates down here a global recession. That's because this is a new Keynesian model. An increase in uncertainty generates a recession. We like that. But the issues concern these 3 panels. What happens is that the US, as the relatively levered investor, loses wealth on impact. And then it regains wealth given high risk premium over time. These dynamics in the US wealth share are mirrored in the real exchange rate. Given home bias, the reduction in US wealth causes a depreciation of the dollar on impact and then an appreciation going forward. And this is reflected in excess foreign bond returns. The message of which is that the dollar over time appreciates in times when equity returns are high, US wealth is rising, and output is rising. And this is the reserve currency paradox of Gurinshaw, Ray, Govio, or Maggiore. These co-movements appear counterfactual. Now let's remind ourselves why a safety shock can address these co-movements. Again, I want to walk through it in 3 steps in parallel with the analytical results I showed you. This is first a world with identical risk aversion and no nominal rigidities. This is a positive safety shock. Everyone wants to hold treasuries. What happens is on impact, well, let's think about here. There are effects on excess returns because the return on safe dollar bonds falls, as I mentioned. But there's very little happening, basically nothing happening to output. In this model, unlike the analytical results, there is a non-zero debt position. The US is going to issue some of these bonds in positive supply, so it's going to earn the seniorage revenue when people want to hold them. So its wealth share is going to go up a little bit. That's going to cause a slight appreciation of the dollar, but not much is going on. If I now introduce nominal rigidities, but keep the same identical risk aversion preferences, now, with nominal rigidities, this flight to safety generates a Keynesian recession. This is true both in the US and abroad. So now we have a co-movement with output, and simultaneously we get an appreciation of the dollar. Okay? So the effects both in goods markets and foreign exchange markets generate that the dollar appreciates in bad times. But we still don't have much happening with the relative wealth of the US because portfolios are quite small. There's not much scope for risk sharing here besides seniorage. Now let's imagine the US is more risk tolerant than the rest of the world. Now it's going to take a large positive position in capital and large negative position in dollar bonds. And so its wealth collapses when there's a flight to safety and then it recovers. So putting it all together, now the dollar is depreciating in times when equity returns are high, US wealth is rising, and output is rising, consistent with the data. Okay, Pierre Olivier.
You mentioned earlier that this is dependent on the fact that you have the Taylor rule.
Do we have the what?
The Taylor rule.
Taylor rule.
So if when you have the safety shock, is there a monetary policy rule that you target the natural rate where you avoid the recession, you avoid the appreciation of the dollar?
Yeah, absolutely. So, I mean, of course, you can't see it here. If I can replicate the path of real interest rates that is achieved in this allocation, I'm going to largely limit the effect on output. Let me just comment. I think for sure this speaks to the, our preferred interpretation is that standard Taylor rules that we think often describe policy feature non-neutral effects. But let me point out, I think, most what we call risk premium shocks in new Keynesian models, the effect of those risk premium shocks on the real allocations come from an insufficient decline in the real rate. I don't think it's just true about convenience yield shocks. It's true about, risk aversion shocks, changes in quantity of risk, and so on. So I think it's a general point than just our paper in terms of a lot hinging on the monetary policy response. Okay, I only have a couple minutes left. Let me show you the key co-movements and then walk through just a couple applications, then I'll finish up. So here are the three key co-movements. I summarized in words at the start of the talk. This is the contemporaneous or the regression coefficient on excess foreign bond returns projected on US output growth. In the data, when US output growth has been falling, excess foreign bond returns are high. That is, dollar bonds are expected to earn low returns going forward. This is the contemporaneous correlation between excess foreign bond returns and the return on equity. This is positive. That is, when equities are doing well, foreign bonds earn a lot of money versus dollar bonds. And this is the contemporaneous correlation between US net foreign assets and excess foreign bond returns. This is positive because the US is effectively borrowing in dollars and going long foreign currency. The model generates both qualitatively and quantitatively these co-movements. If we didn't have safety shocks, you would get, in some cases, directionally the complete long co-movements. This is a manifestation of the reserve currency paradox. If we didn't have differences in risk aversion, in particular, you would miss on the co-movement of net foreign assets. There would not be enough scope for risk sharing across borders. Okay, let me skip this. So as I mentioned, there are 5 applications we then focus on in the rest of the paper. 3 of them have to do with fluctuations, the role of these shocks for macro volatility, the valuation channel and external adjustment, the Great Recession, monetary policy, and then the role of dollar swap lines. The key message is that safety shocks and heterogeneity and risk-bearing capacity, oh, we have 5? Okay, thanks. Thanks for the extra time. The main punchline is that these shocks and heterogeneity and risk-bearing capacity matter for international business cycles and policy transmission. And so kind of where we're coming from in this paper is that it's part of a broader agenda, but financial shocks such as these, if you can call them financial shocks, there's a growing literature on the potential disconnect between macro variables and finance, and we think this is part of a response that at some frequencies they are disconnected, but in other ways, developments in financial markets do matter for real allocations. So with the few minutes I have, let me cherry pick a few of these just to show you the relevance, and I'm happy to chat more afterwards. Let me start with macro volatility. This is in the data, relative volatility in the US and abroad. This is what we have in the model. This is untargeted, but they're pretty close. The key message is that in the absence of safety shocks, the volatility of output in the US would fall by 25% and the rest of the world by 10%. So, to pick on Pierre Olivier, they pointed out this stuff matters in the ZLB, and we want to argue that not just in the ZLB, if you take these policy rules, and we can debate them, that these dynamics, these shocks, matter for macro fluctuations. When investors want to flock to the safe asset as opposed to productive assets, that has effects on real allocations, particularly in the US. Let me now turn to external adjustment, given the work of Elaine and Pierre Olivier on this. So you can look at net foreign assets, and just the budget identity is that the evolution of net foreign assets depends on the return on capital, net exports, and a valuation term. This reflects the change in net foreign assets that is coming from the fact that the US holds a different portfolio than the rest of the world, and there's effects on relative bond returns and exchange rates that would also affect the net foreign asset position. So you can take that identity, you can iterate forward and consider news. And this identity is kind of a not log linearized version of an analogous identity in the seminal 2007 paper of Pierre Olivier and Elaine that basically says if the US net foreign asset position falls, that must forecast either positive trade surpluses or positive valuation adjustments that will stabilize the external position, or a residual H periods from now. Okay, this is kind of like a Campbell-Schiller identity for external positions. So we can use our structural model to actually do this identity in the model economy and ask how much adjustment is coming from each of these things. And the key message is that in the model, most of the adjustment in the US external position is coming from excess returns. In fact, this is, in their seminal paper, it was around 30%. This is saying that even more of that in the model is coming from excess returns. That probably comes to Andreas's question. We don't have some of the macro shocks that would only affect cash flows as opposed to returns, like beta shocks. Okay? But the key message is that if you didn't have differences in risk-bearing capacity, that risk-sharing thing would go away and the valuation channel would no longer stabilize the external position. Now all of the adjustment would have to happen through trade surpluses. Okay, so this is saying that both of these ingredients are there at the same time. Let me skip this. This is just saying that it mattered in the Great Recession. Let me, given the time, talk about monetary policy and then conclude. In now a couple papers, Moritz and I have been exploring the role of redistribution in these types of models with investors having differences in risk-bearing capacity in the transmission of monetary policy. In our paper in Econometrica, we argue that in a conventional sort of standard closed economy New Keynesian model, a monetary policy easing systematically will redistribute wealth to relatively risk-tolerant investors, because those investors will endogenously be levered in capital, and a monetary easing will redistribute to them by inflating away their nominal debt burden, by raising the profits they earn through capital and raising the price of capital. In some new work, we've pointed out there are similar mechanisms operating in a preferred habitat model of the term structure. In this paper, there are two countries, the US and foreign. There are two monetary policy shocks, a US policy shock and a foreign monetary policy shock. And exchange rates also redistribute. And the key insight in this application is that if you contrast a US monetary policy easing with a foreign monetary policy easing, importantly, a US easing depreciates the dollar, whereas a foreign easing appreciates the dollar. Ex ante in this model, relatively risk-tolerant agents are going to finance themselves in dollars. So when the US Fed eases and the dollar depreciates, that lowers the real debt burden of those levered risk-taking agents. That recapitalizes them, lowers the global price of risk, and compresses risk premia. You would get the exact opposite mechanism if the foreign central bank eases. And so we have put some numbers against this. I'm not going to go through in the interest of time, but let me just say, one of the things we think this is interesting is that it draws a line between the work on the global financial cycle, which Elaine and many others have contributed to, and this literature on the exorbitant privilege and the role of the US in terms of its unique external balance sheet in the international monetary system. We think about dollar swap lines. Hopefully you get the main idea. Let me conclude. On this paper, we propose a business cycle model with three key ingredients: a time-varying demand for safe dollar bonds, differences in risk-bearing capacity, and nominal frictions. The key mechanism is that a flight to safety generates simultaneously a Keynesian recession and a dollar appreciation. Ex ante, relatively risk-tolerant agents are going to finance themselves in dollars, matching patterns of global portfolios, and the dollar is going to earn a negative risk premium, matching patterns in currency markets. We validate the model with real and financial data and argue that it matters for macro and policy. So thanks very much.